All right, a look at the Asian markets. They are lower, and that is following the sort of decline that we saw on Wall Street yesterday, near 2018 lows for all the major indices on the Wall Street. The Asian markets trading with deep cuts this morning, following an overnight sell-off on Wall Street. Now, what is keenly awaited is Chinese Premier Xi Jinping's speech to commemorate the 40th anniversary of its economic reforms and opening up the reform that was led by Deng Xiaoping. The Japanese index, while it's down about 1%, it has recovered a fair bit from the lows as well. There is some strength seen on the dollar yen, so let's see how the Japanese exporters are faring. The Korean index too has moved off the lows of the day, currently sitting with just below the flat line, a 1.5-point cut. The Straits and the Taiwanese indices on tenterhooks ahead of the speech that comes in from the Chinese Premier, and the Straits is actually underperforming with a cut of about 1.5%. The SGX Nifty indicating a cut, but indicating a much milder cut. In fact, the start is likely to be around the 10,900 mark as against the other indices which are showing much deeper cuts.
Okay, so it looks like the Indian markets will outperform today as well, the global peers, but this all because the US stocks finished sharply lower, with the S&P 500 falling to a new low for the year. The Dow Jones lost over 500 points, bringing its two-day losses to more than 1,000 points now. Now, the tech-heavy Nasdaq Composite dropped to 2%, led by a fall in Microsoft as well as Amazon shares. Also important to note here is that the Dow and S&P 500 are both in correction territory, are on track for the worst December performance since the Great Depression in 1931. So the cues in US not really looking good. The investors are eyeing out for the FOMC meeting, which starts today. The expectation is that there will be a rate hike, but the market is really watching out for the tone coming in from the US Fed. But let's go across to Deirdre Bosa, our colleague at CNBC, who's getting us a wrap of all that transpired on Wall Street yesterday.
U.S. stocks sliding into the close, the Dow losing more than 2%, off more than 500 points. The S&P down 54, and the Nasdaq lower by 156 points. Homebuilder sentiment falling in December to the lowest point in more than 3 years. According to the National Association of Homebuilders Wells Fargo Housing Market Index, homebuilder sentiment declined to its lowest point since May of 2015. The index has plummeted nearly 20 points over the past year, while potential buyers hesitate to purchase new homes, even as mortgage rates have pulled back in recent weeks. Another down day for oil, with prices declining nearly 3% to a 14-month low on concerns of oversupply in the market. Oil prices settling under $50 a barrel to start the week and have fallen about 30% since October as global inventories continue to rise. And health insurance and hospital stocks taking a hit today. That after a federal judge in Texas declared late Friday that ACA, better known as Obamacare, is unconstitutional. Though the appeals process still has to play out, companies like Molina Healthcare off 8% and Centene down about 5%, leading the market lower. That's the action from the U.S. market. Back over to you in Mumbai.
All right, that's as far as the U.S. markets are concerned. And remember, as Wall Street falls into correction territory, Double Line's Jeff Gundlach says the U.S. equities are in the long-term bear market. In a CNBC exclusive, he says passive investing has reached mania status and will exacerbate market problems.
I'm pretty sure this is a bear market. I mean, people like this definition of 20% down as a bear market, but that's obviously very arbitrary. I've been around for over 35 years in this business, and I've seen a number of bear markets, and it's more about kind of how you lead into it, how it develops, and how the sentiment changes. And I think we've had pretty much all of the variables that characterize a bear market.
Okay, but now the big question is that will the Federal Reserve, what will they do tomorrow? Will they hike or will they not hike? Here is Steve Leisman with what are the key expectations from US Fed in the meeting, which is going to be underway from today.
Well, if the Fed is going to weigh the pros and cons and likely come out on the side of hiking, but it is a much closer call than any of the prior hikes this year. Here's just a few of the factors the Fed will be weighing. The pro, the economic data is strong. The con, the outlook is weaker. The pro, there's a lot of fiscal stimulus out there and tax cuts as well, but market sentiment has turned deeply negative and could, in fact, create its own universe of weaker economic outcomes. Fed Chair Jay Powell has already said the way to handle uncertainty, move more slowly. And it's unclear if that applies to December, but it definitely applies to 2019. Markets more or less expect a rate hike, followed by a decline in the Fed's own forecast for future hikes. What might that look like? Here's what it looks like now. Each bar there represents the number of Fed officials who are forecasting a given number of hikes next year. So 3 are forecasting fewer than 2 hikes. That assumes they hike by a quarter point in December. 2 are at 4 at 2 hikes, 4 at 3 hikes, 4 at 4 hikes. So you see a lot of distribution. The average there is 3. That may move back to an average of 2 hikes forecast for each Fed member. The question is whether the Fed will back off enough for a market that seems to be saying no more hikes, and some beginning to whisper, I say, maybe the next move by the Fed will be to cut rates.
Okay, so all eyes on the commentary coming in from the US Fed. But on that note, here is some opinion coming in from experts as well on what they are expecting from the Fed tomorrow.
There's a very strong desire in the market recognizing the weakness that's developed as liquidity is pulled out of the system, that the Fed needs to slow down the pace. So it isn't so much their comments, it's really the reality underneath that says the Fed really needs to ease up, slow down, and not make the next step that they want in raising rates. Probably 2 raises next year would be a better target for the Fed, but also the pace at which they allow their huge balance sheet to run off. As they let that run off, that is really sucking liquidity out of the market. And I think that's why you're seeing decelerating growth, why you're seeing rates move up away from treasuries, and why you're seeing signs that there's a little fragility in the financial markets pretty much around the world.
If you look at the market sentiment since really the start of the year, where they were concerned about inflation, now they're concerned about downside risk to growth, it's very typical of market sentiment, of behavior, emotion, where they swing from one extreme to the other. But at the same time, if you look at the macroeconomic data, it's still telling us that the economy is in reasonably good shape, and the risk is actually more towards inflation in the short term rather than the other side. But obviously, I think this particular meeting is very critical to give us a picture or a sense of how does the Fed view financial indicators, because we have seen the stock market correct, we have seen credit spread widen to some extent, and whether the Fed will now be following these financial indicators more than it used to be, I think this is the interesting observing point for this particular Fed meeting.
All right, with that, let's take a look at the European markets. There, the markets closed lower amid escalating concerns of a sharp slowdown in global growth, mirroring the sort of cuts that we saw in the US markets. On to developments on the Brexit front. The UK Prime Minister Theresa May announced in the Parliament that a meaningful vote on her Brexit deal would take place on the week commencing January 14th. Remember, Britain has just over 100 days to leave the bloc on March 29th, and chances of a no deal or a chaotic Brexit deal have gone up after strong oppositions to May's draft deal. That said, the retail index was the key underperformer in the European markets. ASOS reported a weak set of numbers. In fact, the stock was down close to around 3.5–4%. In the emerging market space too, we saw some moves come by.
Okay, so that was about the equities and how the European markets fared yesterday. But in the currency space, the dollar weakens ahead of the Federal Reserve's policy meeting that will likely result in an increase in interest rates, but signal a more cautious tone for the economy for the next year.
In the world of commodities, crude oil prices declined to a 14-month low amidst oversupply concerns. Brent trades below the $60 per barrel mark.
We get to 45, which we're now $4 from being there. You're now pricing in the 08-09 recession, the 2001 recession, and I think everybody on this show will agree that the probability of seeing that scale of a recession right now is quite low. In fact, we estimate at $45 a barrel, you're pricing in a 1.5 million barrel per day year-over-year loss in demand. Now, the question is, that's the demand side. And you look at, if you decompose the movements in price and the movements in supply, the market has priced in the improvement on supply. What we've seen not only in commodities and oil, but a deterioration in the demand prospects. Very rare that you see stocks, bonds, and commodities all down together.
With that, we slip into a quick break. Come back, we'll tell you all the cues and news that lined up for trade this morning.